General Mills, stock ticker GIS, is down 18.4% since January 2023. It is currently trading close to its 52-week low at $63 per share, which is over 30% from its all-time high in May 2023. So, is this a good buying opportunity for General Mills, or will the stock continue to fall in 2024? In this video, we will answer this question by analyzing the General Mills stock, reviewing important financial metrics, comparing the stock's performance against competitors, and assessing the stock's dividend safety. By the end of the video, we will run the numbers through our valuation model, deciding on an acceptable buy price, and I'll also share with you my strategy and what I've been doing with General Mills in my own portfolio. Before commencing our analysis, I first want to welcome you all to Investopia, where we discuss everything finance. I also want to share a friendly disclaimer. Please remember that this is not financial or investment advice, and that you should always do your own due diligence and make decisions based on your own circumstances. With that being said, let's get right into it. General Mills is a global packaged food company that produces a diversified mix of cereal, snacks, baking products, pet food, and more. It is also one of the largest US producers of organic packaged food. Their portfolio contains over 100 consumer brands, including 9 iconic brands that each represent more than $1 billion in retail sales worldwide. All 9 brands are listed on the screen right now, but some famous examples are Betty Crocker, Nature Valley, Cheerios, Häagen-Dazs, and Yoplait. At the time of filming this video, General Mills is a large cap company with a market cap of $35.9 billion. It is trading at a price to earnings ratio of 15.4 and has a nice dividend yield of 3.74%. Looking at the stock's performance over the last 5 years versus the S&P 500, we can see that General Mills has significantly lagged the S&P, increasing 46% since January 2019, while the S&P increased 82%. However, if we compare the return as of May 2023, which is just before the stock started declining, we see that General Mills was actually outperforming the index by almost 55 percentage points, doubling the return of the S&P index up until that point. Now, when comparing its performance with its competitors, Kraft Heinz, Kellogg, which is currently known as Killanova, McCormick, and Hormel Foods over the last 5 years, we'll notice that the entire industry has been underperforming. In fact, we can see that General Mills actually had the best performance out of the bunch, with McCormick coming second with a 7% return. Kellogg is basically flat since 2019, while Hormel Foods and Kraft Heinz had over 20% decreases in their share price. Moving on to General Mills' financial statements, we can see that revenues grew from $16.3 billion in 2018 to $20.2 billion in the trailing 12 months. That's a CAGR, or an average annual growth rate, of 5.5%. Similarly, we can see that net income increased from $2 billion in 2018 to $2.4 billion, which is a CAGR of 4.6%. However, unlike revenues, which consistently increased year to year, net income dropped in 2021, and it looks like 2023 will also see a drop in profits. Nothing significant, but worth noting. Now, we generally want to see at least 3 to 5% growth rates for mature and well-established companies, so General Mills does check that box. As for the balance sheet, we see that the cash balance in 2018 was $533 million and increased to $594 million in the trailing 12 months. Current assets, which also includes the cash balance, increased from $4.2 billion to $5 billion, which is a 4.4% annual growth rate. Net debt, which is the sum of short and long-term debt minus cash and cash equivalents, decreased from $14.7 billion in 2018 to $12.1 billion. That is an average decrease of 4.8% per year. So while all 3 metrics are moving in the right direction, which is really good to see, the debt does look relatively high. In terms of the dividend, General Mills has a dividend safety score of 90 out of 100, which gives it a very safe rating and means that a dividend cut is highly unlikely. It has an outstanding streak of paying dividends every single year for 125 years without a reduction, and has been increasing the dividend for the past 3 years. Now, to be fair, their dividend growth record was much better, as you can see from this graph, increasing since 2004. However, they decided to freeze the dividend from 2018 to 2020 due to major acquisitions. This is also the reason for their relatively high debt, which we saw earlier, which spiked in 2018 as a result of the acquisition of Blue Buffalo, the pet food brand. Despite the freeze, the dividend has been increasing on average 2% in the last 5 years and 7% in the last 20 years, with the latest increase coming at 9.3% in June 2023. As we see here, General Mills' dividend yield of 3.7% is higher than its 5-year average of 3.3%, which could possibly indicate undervaluation. Similarly, the forward PE ratio also indicates undervaluation, currently at 13.9 compared to its 5-year average of 16.6. Although both metrics do indicate undervaluation, as we always say, we should not look at any metrics in isolation and will only make conclusions by the end of the video. General Mills' earnings payout ratio is currently 51%, which is lower than our preferred 60% threshold. We generally want it to be less than 60% as it gives the company space to continue increasing the dividend in the future. As you know, I personally prefer to use the free cash flow payout ratio as the earnings payout ratio can be subject to accounting manipulation. Again, anything under 60% is our preference, and as we can see here, General Mills' free cash flow payout ratio is currently 57% and expected to drop to 52% in 2024. Moving on, we see that earnings per share and free cash flow per share have been steadily increasing since 2013. The free cash flow has had a few dips, but the general trend is still upwards in the right direction, which is good to see. Shares outstanding have decreased from 646 million shares in 2014 to 593 million shares today, meaning that General Mills has been buying back its own shares. We generally like to see declining shares as it signifies that our ownership stake of the company is getting bigger and that the company's profits are being distributed on less and less shares. Now, coming to General Mills' return on equity and return on invested capital, and just in case you don't remember, a high return on equity usually signifies a company's moat, while the return on invested capital reflects management's ability to effectively allocate and reinvest capital. Generally, we like to see a minimum of 10% for both metrics, however, the thresholds could change slightly depending on the industry. As you can see here, General Mills' return on equity is consistently in the mid-20s, which is comfortably over the 15% threshold that we like to see for consumer staples, indicating a strong moat. As for the return on invested capital, it's also mostly over our preferred 12% threshold for consumer staples, except for a slight drop to 11% in 2018 as a result of the Blue Buffalo acquisition that we discussed earlier. Despite that, the company is averaging around 14.5% return on invested capital over the 10-year period, which is nice to see. As for net debt to EBITDA, which is earnings before interest, taxes, depreciation, and amortization, we like to see it under 4 for consumer staples, and it's currently under that threshold at 2.89. This means that it would take General Mills less than 3 years to pay all the company's debt with their net cash on hand. Now, there was a bit of a spike in 2018 due to the acquisition, but since then, the company has been recovering well, steadily chipping away at its debt and maintaining healthier debt levels. We see similar patterns for net debt to capital and interest coverage, with General Mills currently surpassing the preferred threshold for consumer staples and steadily recovering from the 2018 increases. One last thing to check before moving on to the valuation models is how did General Mills perform in the last recession of 07-08, especially with the ongoing speculations of a recession in the near future. As we can see here, General Mills actually increased the dividend during the recession. Their sales also increased slightly by 0.1% despite the economic slowdown, at the time that most other companies actually reported declining sales. And finally, the stocks declined by 12%, comfortably beat the S&P 500, which declined by 55%. So if you're looking for a recession-resistant stock, General Mills might be worth a look. Jumping into our valuation models, we'll be reviewing 4 distinct models to get to our intrinsic value and acceptable buy price. If you're enjoying the content so far, please smash the like button and subscribe to the channel to ensure that you're notified once we release similar videos in the future. Our first valuation model is the discounted free cash flow model, where we estimate General Mills' intrinsic value based on the present value of their estimated future cash flows. We can see here the free cash flow that General Mills generated over the last 10 years, growing at an average 4.2% per year. Based on analyst estimates, we use a conservative 4% growth rate for future free cash flows. Using an 8% discount rate, which is also our desired rate of return, we get the present value of all future free cash flows as well as our terminal value. Adding them together, plus cash and cash equivalents minus total debt, we get our enterprise value, which is the estimated total value of the company in 10 years. Dividing the enterprise value by the total shares outstanding, we get a fair value of $70 per share, which is above General Mills' current stock price of $63, indicating possible undervaluation. The second method is the multiples valuation model, where we obtain General Mills' fair value based on the multiples of its competitors and companies within the same industry. We do so by getting the current PE multiples, calculating the average PE, and multiplying it by General Mills' current earnings per share to get our fair value, which is $89. The third method is the dividend discount model, where we estimate General Mills' fair value based on the present value of future dividend payments, specifically used for dividend-paying stocks. We see here General Mills' total dividend paid per share in the last 5 years, which grew on average 2.92% per year. Now, I think this growth rate is a bit skewed due to the company's decision to freeze dividend growth in 2018 as a result of the acquisition. And if we recall, General Mills' 20-year growth rate is 7%. So while remaining on the conservative side, I decided to go with a 5% growth rate for future dividends, which I think is very reasonable considering the company's dividend record and the decreasing debt levels. Discounted at 8%, we get a fair value of $79 per share, which is also higher than the current stock price. The last method that we will review today is the historical multiples valuation model, where we estimate General Mills' fair value by considering the normal PE ratios that the stock traded at historically. In our analysis, we'll use the 5, 10, and 20 years normal PE. As we can see here, the General Mills stock was trading at an average 17.26 PE during the last 5 years, 18.03 for the last 10 years, and 17.21 in the last 20 years. We calculate their average and multiply it by General Mills' current earnings per share to get our fair value of $72 per share. Finally, to obtain our intrinsic value and acceptable buy price, we take the average of the 4 fair value estimates generated by our model. The intrinsic value we get is $77.4 per share, which is higher than the current stock price but lower than its 52-week high. Without a margin of safety, the stock would be a buy at the current price. However, we always want to have a margin of safety to protect against downside risk. For high-quality companies, with a wide moat, strong balance sheet, and good forward-looking data, a 10% margin of safety could be justified. With a 10% margin of safety, our acceptable buy price would be $70. So you might be wondering, what is the ideal margin of safety? Well, the short answer is, it depends. You must consider the risks associated with the industry or the sector that your company operates in, as well as your risk tolerance, to determine a reasonable margin of safety. Taking a quick look at General Mills' latest earnings report, we see that they highlighted 2 potential risks. 1, increasing price elasticity, and 2, consumer value-seeking behaviors. The main reason General Mills performs so well during recessions is due to the inelastic nature of the products that they sell. Since their products are considered necessities, consumers tend to buy them regardless of changes in price or economic conditions. However, if price elasticity increases, indicating increased consumer sensitivity to price hikes, demand may decrease with higher prices, potentially impacting General Mills' margins, especially in a high interest rate environment. The second risk, which is consumer value-seeking behaviors, is a result of higher price elasticity as well. As prices rise, consumers may turn to more affordable private label alternatives instead of premium brands like General Mills, decreasing overall demand and putting pressure on future profit margins. Given these potential headwinds, you might want to consider a higher margin of safety. For a 15% margin of safety, the acceptable buy price would be $66. If you're looking for a 20% margin of safety, your buy price would be $62, which is slightly lower than the current price, but still above its recent 52-week low. If you want an even higher margin of safety, say 25%, the acceptable buy price would be $58, which is lower than the stock's 52-week low. In terms of Wall Street's expectations for General Mills stock, they are forecasting it to trade at $69.4 per share in 12 months, which is less than our estimated intrinsic value, but higher than the current stock price, implying a 10% potential upside from current levels. Now, I personally prefer a 15 to 20% margin of safety for General Mills. I do believe the company has a wide moat, a good and improving balance sheet, as well as an attractive dividend record. As for the risks that we discussed, I think for the most part they're already priced in the current stock price, and I do believe General Mills will be able to weather the storm and preserve its market share long term. And as you probably guessed by now, I do own a position in the company and will continue to add to it as the stock continues to fall closer to its 52-week low. If you would like to learn more about other attractive opportunities in the current market, make sure to watch the next 2 videos in which we will analyze 2 undervalued stocks with great potential upside and over 90 years of uninterrupted dividend payments. Let me know in the comments below your thoughts about the stock. Do you agree with Wall Street's price target and our intrinsic value? Do you believe General Mills to be a strong buy at the current levels? Or do you believe the downside risks outweigh the potential upside return? With that being said, don't forget to like and subscribe, and I'll see you in the next video.